Hello, chart watchers, and welcome to this Thursday, August 22nd, 2019 Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. A little bit of a mixed picture. We are lower today, but the Dow Jones and S&P holding up a little bit better than the NASDAQ. You can see the Dow Jones currently flat, down a half a point. The S&P 500 down a bit more, down 9 points. The NASDAQ down 55, and the Russell 2000 down 5. 10-year Treasury yield is on the move higher at 1.60%, up about 2 basis points. Volatility index, this is the biggest move we've seen here in a little while, up about 8% today, but it is off a downtrend and is coming off of the lowest close in August. But still, it is rising with little weakness in the market. Financials benefiting from that rising 10-year Treasury yield. You can see here we got a nice little uptrend starting over the past 5 or 6 days. That's coinciding with this slight move higher here in the 10-year Treasury yield. Energy also having a little bit of a bounce. Crude oil prices have been moving up a little bit. Consumer staples also having a good day. It is in the defensive area. Market a little weak. Trying to get this breakout up here. Not able to do it just yet, but currently holding up better than most areas. Technology among the weaker groups today. You can see it did get back up above its moving averages, has pulled back today. Be interesting to see whether or not it holds the area of the breakout. I'm just looking at this short-term resistance area. Life insurance and banks both benefit when the Treasury yield goes higher. And you can see both these groups doing pretty well today, helping to lead the financials higher. Another area that has finally come to life, at least a little bit, is the apparel retail group. And this group you can see up about 1% today. Part of that reason, Nordstrom's came out with a really nice earnings report. Well, relatively speaking, a nice earnings report. They beat on their bottom line. We'll go over that in just a bit, but they did miss on their revenues. They lowered the high end of their fiscal year 20 earnings per share, but I think this is just a little bit of a relief rally. Nordstrom's has been beaten up so badly. L Brands, though, is on the other side of the spectrum. These are two apparel retail groups, Nordstrom and L Brands. Nordstrom's the best performer in the S&P 500. L Brands, the worst performer in the S&P 500. So literally a first to worst story in the retail apparel group. All right, Aaron, well, we're just kind of hesitating right here around this resistance. We talked about it quite a bit yesterday with Danielle Shea, and still not able to move through, at least no sustained move. What do you think?
Yes, I have to agree. My indicators, though, are starting to look up. I wrote about it yesterday in my blog. We're seeing, actually things are turning up. The intermediate term indicators, we're getting good crossovers. So, as much as I feel like this market is really shaky at this point, my indicators are telling me that, we might break out here.
Yeah, I'm cautiously bullish. I think that's probably a good way of putting it. I mean, nice little rally here. I like seeing the volatility index move down, even though it's up today. It's been this nice little downtrend. As I mentioned, closed at an August low yesterday. So that's helpful. We're not in that panic state that we were, but we got to clear this price resistance, no doubt. I think that's what's maybe just causing the market a little to be a little jittery today.
Absolutely.
All right, we got a special guest in here, Rick Bensignor. Rick, how are you doing today?
I'm good, Tom. How are you?
I'm doing very well, thank you. Welcome back to Market Watchers Live. It's a pleasure having you on here.
Well, looking forward to our presentation today. It's going to be a little different than normal because we're going to take a look at moving averages and hopefully show viewers a very different way of using them.
Awesome. I like that, putting everybody on edge here. Now you got to wait and see what Rick's going to be talking about.
We tease you.
Exactly, a little teaser. We're going to be getting back to you, Rick, in about 10 minutes. So if you can hang in there with us, that'd be great.
Sure.
All right, Aaron, what do we got today?
All righty. Tom, you've got a workshop next week on Tuesday. Jesse Felder is going to join us on Wednesday, and the seasonality report will be next week as well. So it looks like you're going to have a pretty busy week there, Tom. As far as today, we will start off with In the Know Trader after our news and headlines. 10 and 10. First symbol is going to be Infosys Technologies, INFI. So you'll want to go take a look at that before Tom gets to it. And let's go ahead and start it with our technical news and headlines.
All right, sounds good. Well, we did have a couple economic reports out this morning, and they were a little mixed. First, you can see the initial jobless claims came in better than expected, 209,000 versus 216,000. But the August PMI composite flash, and the flash comes out about 10 days before the actual report, is showing some weakness there, 50.9 versus 51.9. And the manufacturing component was 49.9 versus an expected 50.2. And that 50 level is the difference between the economy growing and maybe contracting. So we're hovering right around that 50 level. And when that report came out this morning, that's about when the stock market began to have some issues. So I think the market's focusing a little bit on that, still worried about a possible recession with the yield curve hovering around that inversion. July leading indicators came out and they were pretty strong, rose 0.5% versus 0.2% expected. As far as the reaction in the bond market, maybe a little bit surprising with the fact that that PMI composite flash came in a little lower than expected. You'd think maybe that might lower the 10-year Treasury yield, but instead we are higher, trying to break out to about a 7 trading day high right here, which would be bullish for banks, life insurance companies, some of those financial groups that have been underperforming for a while. They've been underperforming because of these falling yields. If we can start to, maybe prop the 10-year Treasury up a little bit, I think we'll see a little relief rally continue in those areas. Earnings reports out. A number of earnings reports came out last night and this morning, and most of them pretty strong. I mean, as you can see on your screen here, many of these did beat estimates. Actually, all of these on the screen beat estimates. And we got another slew coming up after the bell today, including Salesforce.com, Intuit, VMware, along with Ross Stores. So some pretty big names to report after the bell today. All right, looking at what's going on in the market, I'll take a look at a couple of charts. But first, I wanted to just show you financials. Here's where we're seeing that leadership. Energy, doing very well here, but technology having a rough go of it, and actually materials now performing just a little bit worse. So there's a mixed picture as far as what's going on in the market. We've had a lot of wide participation to the upside recently, but that is not the case today. I mentioned the apparel retailers earlier. You can see the move here. Apparel retail trying to get back through some overhead resistance. Still not a healthy group. It's been a healthy advance the last week or so, but you can see from a longer term perspective, a lot of work still to be done here in the apparel retail space. If we pull up Nordstrom's, wanted to bring this one up, take a look at that relative chart. And you can see that Nordstrom's has been under pressure for a long time. Yes, a little bit of a relief rally, but this long-term relative weakness has me still somewhat concerned. Maybe if we can break above that late July relative high right here, that could bode well for Nordstrom's maybe in the near term. But still, the group's been under pressure and Nordstrom's been one of the laggards. So I don't know. Seems to me like it might just be a little bit of a relief rally. L Brands, big move down here. Another one that's been absolutely horrible in terms of relative strength. And today we found out why. L Brands came up, not only missed on in terms of its revenues, but it did guide Q3 earnings per share lower as well. So they beat on their bottom line, but not a very good overall report. We'll see whether or not this is a turning point here, maybe an exhaustive move down on L Brands given the heavy volume today, but still we're gonna have to wait and see on that. All right, before we get into the scooter mover of the day, I did want to play a clip from yesterday's 10 in 10. Listen in for a minute. The most important thing is not even on this chart, and that is that they report earnings after the bell today. So you want to keep that in mind. I mean, this thing could go any way, but I would be watching those two levels. We're at about $89 right now. If we could close or open tomorrow above, say, 94 and clear, open at a new high, I think that would be very bullish, especially if you got a beat on the top and bottom line. To the downside, I think we got to watch around 82 bucks. Welcome back, everybody. On that 10 in 10 yesterday, I did mention gapping up above that 94 level would be very bullish. I actually bought the stock today, and this is how I trade these gaps. You can see the huge move here, the big gap up. We came back down intraday. I like to kind of watch what's going on early on. I don't just jump in. But once we came down and started to turn back higher, I put in a stop buy at the open. When I get an open like this where we clear prior candle bodies, not necessarily the intraday highs, but the candle bodies, the opens or closes. When we open higher, go back down below, and it's in a stock or an area of the market that I really like, sometimes I'll put these stop buys in as we move back to the upside. I think that gives us a pretty good indication that the stock is under some significant demand. You can see right here the volume is going to be the heaviest today since back in November of last year. And when you take a look at the relative strength here, this is a stock that was already looking pretty good. And now with their earnings report, they beat top line, beat bottom line. They guided their Q3 revenues higher, and now we're getting a price breakout to boot. I think Keysight looks pretty good. And for that reason, it is your scooter mover of the day.
All right, let's look at some upgrades and downgrades today, a few names you may recognize. First, I'm going to start with Cerner Corp. It was upgraded by Argus from a hold to a buy. They did not give us a target on it, but I can see why they might be on the buy signal here. I do like the looks of this chart. You do have a short-term double bottom, and it was really struggling to get past that overhead resistance. Looks like we have right now, but the only issue I would have, and I'm going to really scoot this in so you can see it, is that currently we are trading just below that area of resistance. We got the pop earlier today, but we're now pulling back toward the bottom. So that would make me a little bit more concerned about whether this breakout will hold. If it does, next area of overhead resistance is about $74. Next one up, $76.55. And I was looking at the PMO. It is actually turning, and it does look like it is ready for a buy signal. Currently, it is not on the buy signal, but coming close. And then I was noting that as far as volume goes, not overly impressed right now. You're not getting I'm still seeing declining tops on the OBV, but on the positive side, I do see in the very short term rising bottoms on the OBV. So that could still be good. A scooter of about 80 here is also healthy. So I could agree with this particular upgrade. Next one is Etsy, and Etsy's had a little bit of stumbling and some trouble here. I'm going to take this a little bit further out. Really it has been stuck in a trading range for a little while here, and it's broke out of it only on the wrong part. It broke down, and it broke down below that 200-day EMA. And it looks like it's hooking. It's trying to come right back up here. We are starting to see, excuse me, PMO is rising now. So that's a nice little look there. And of course, this rally coming up does look somewhat promising. We never had to really worry about the support levels. Let's see, where did we never ended up this far down. Looking at where it's stopping right now, let's grab that. It does sort of line up right here with some of these lows that we saw back in January and February. I like the look of the chart, but I'm not convinced at this point about that particular upgrade, mainly because it has fallen below that 200-day. Everything's looking pretty soft here. The next one I'll look at real quick is Toll Brothers, and that is downgraded by Wells Fargo today from an outperform to a market perform. And what I noticed on this chart right off the bat was a descending triangle. And these are bearish formations. Every time a price gets up to try and challenge previous overhead resistance, it fails even before it reaches. It's still holding that support level, but the expectation would be a breakdown from here. So I think the downgrade for Toll Brothers is certainly warranted. And I know I wouldn't be buying it right now. That's all I have for upgrades and downgrades. We will be right back after this with Rick Bensignor.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have chart school and creative strategy videos to help you become a better technical trader. Leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
Well, it is my pleasure to bring back Rick Bensignor. He has had quite the career. He is in charge of, you are CEO of the InTheKnowTrader.com, but you've worked for Morgan Stanley, Wells Fargo, Bloomberg, quite a bit of experience here. So I'm really looking forward to hearing what you have to say.
Thanks, Erin. Well, today we're going to look at moving averages, a very commonly used technical indicator that people overlay on their charts. But I kind of want to show you a different way of using them compared to how you're typically accustomed and generally taught in technical analysis textbooks, technical analysis classes. So we're going to walk through some very basic things here, and ultimately we'll get to a model that I've been using myself for over 30 years and having taught institutions for about 25 years already. So let's just start off. Obviously, we know that moving averages are a simple filter. Some traders use a simple moving average and a single moving average as a filtering device, bullish above, bearish beneath. So here, let's take a look at something like the NASDAQ comp. This is actually, it's a 30-month moving average. It's not weekly, it's monthly. So it's labeled wrong on the top. And here we show with a 30-month moving average going back 20 years, if you simply played above and beneath and use the moving average as your filter, you've done remarkably well in 30 years. Using the same NASDAQ comp, but this time looking at a weekly chart, you did pretty darn well too. But you can see in the latter part of 2015 and halfway into 2016, you got chopped up many times, just getting long above, short beneath as it kept playing with it. But ultimately, we're long from middle of 2016 all the way to looks like late summer, early fall of 2018, in which in theory you would have turned short on the break and then got back long in early 2019, pretty much same place you got short, and you've been bullish since. So also same type, good making money. This is also, again, the weekly symbol here in the middle is wrong. It's actually a 30-day moving average on a daily chart. And you can see here that you'll still make money, but you certainly can get chopped. And all I did here was default to a simple either 30-day, 30-week, or 30-month moving average to give you the sense of what this says. Look at some other charts. Here's Home Depot with a 30-day moving average. Same type of thing. You can capture some of the trends, but you can also get chopped up a heck of a lot. Here's where you get destroyed in something going sideways for a fair amount of time. This was Walgreens Boots with a 30-week moving average. And from the middle of 2015, essentially through almost all of 2017, you just got clobbered. So there's pros and cons to using a simple moving average and a single moving average. So at some point, someone said, hey, let's use two. And generally, we'll use the interpretation that when the shorter term moving average, assuming if you use two, one of them is going to be less time framed than the other. So one by default is shorter. If the shorter term moving average crosses up through the longer term moving average, it's bullish. You get long and you stay long until that shorter term moving average flips down and goes through the longer term one, in which case you get out of your longs and you go short. Now, one of the things about this is this model, which many funds trade, will always be in the market. So there's never a time it's not in. It's simply taking the signal. So here, let's take a look at a nice trending tech stock for a while. Here's MICRON with a 10 and 30 week moving average. The 10 is the red line. The 30 is the blue. And from early 2013, you got a positive cross, and you rode this all the way through just about early 2015. Made a killing on the upside, made a pretty darn good killing on the downside going into 2016. In the middle of 2016, this flips back to being bullish, and you would have rode it all the way until looks like about summer of 2018, where it got you bearish. You did really well, and now you're a little bit into choppy session. So this looks pretty good. Let's take MICRON with a 10 and 30-day moving average, and you can see you can still make some decent money with this model, but there are going to be periods of time that you get chopped. let's take a look at Boeing on a 10 and 30 day. Going all the way back to 2016, the lower left-hand corner of this chart, red crosses over blue, and you're basically in this, the bulk of the move. Occasionally you might get knocked out, but all the way into early 2018, this would have kept you long. And then in 2018, it would not have been a fun year because you almost always paid higher than you sold and almost always sold lower than you paid. You caught a decent move in the early part of 19, and it's you've given back a fair amount of that just with the choppiness. Here's Boeing on a 50 and 200 day, and I switched the 10 and 30 purposely to 50 and 200 because this is what so much of Wall Street looks at, and for no particular reason other than it had appeared, I don't know, 30, 35 years ago in somebody's written work, and ever since. It was sometime in the 1980s, someone wrote a piece that included 50 and 200 day, and all of a sudden that's what everybody looked at. And so here, if we look at this on a daily chart for Boeing, going back to 2016, same type thing, you're in a bullish mode. It stays bullish until the end of 2018. And then you unfortunately buy very high in 2019, not far from, I don't know, maybe $20 from the top or so, and then get knocked out at, I don't know, looks like about 355 or so, and you'd still be short at 355. So what happens is you get you get decent results, but sometimes it's really bad. So leave it to Wall Street to say, well, if 1 is maybe okay and 2 looks better, let's try 3. So somebody came up with 3 moving averages. I think this was late 70s to early 80s. And here what they would try to do, and this first showed up, as far as I know, in the commodity markets. They would use 4, 9, and 18-day moving averages. When the 4 crossed up through the 9, it would mean don't be short. And when the 9 crossed up through the 18, it would be a get long signal. And you would hold that until the 4 crossed down underneath the 9, in which case you covered, you exited the long. And if the 9 crossed down then underneath the 18, you'd actually go short. So that was the method. It didn't work particularly well at all. So I had been looking at this stuff for years because I grew up in the commodities markets. I actually started trading in the pit in 1981. And in college, I was already trading futures from my dorm room. And when I graduated, I started in the pits, in 1983, I started in the pit and was there until 1995, trading stock index futures, gold, silver, copper, sugar, and cocoa. So I've traded all those markets in the pits themselves, and often would come into the pit each morning looking for these potential crossovers off of daily charts. Would I see fund selling coming in or fund buying, etc.? What I realized was it did not work very well at all. But I knew there was a good concept in moving averages. But I realized that more often than not, crossing moving averages did not indicate trend. They actually indicated lack of trend. And that was almost completely opposite to everything I knew I had been taught about how to use moving averages and crossovers. So about, let me think when this was. By mid-1980s, I developed a TMAP model. I trademarked it. It's called TMAP. And I find that it's one of the most effective tools that you can use in order to figure out when a trade starts, the continuance of the trade, and the trend, and most importantly, the conclusion of a market trend. And I have taught this to hundreds, if not probably thousands, of Wall Street institutional traders and portfolio managers who over the years have come back and told me that this is the single most important thing they will look at just to get a sense of where you are in a general trend and if there's trend. So what's TMAP? Well, it's really simple stuff. You can do this on any charting package. You set up 3 moving averages. Typically, I default to 20, 35, and 50, and I use simple moving averages. What I want to see for a buy signal is price to get above an upward sloping 20-period moving average. the 20 needs to be above the 35, and the 35 needs to be above the 50. Essentially, I'm going to want to see all three moving averages having positive slope, and at a minimum, the 20 and 35 having positive slope, because the 50 is the slowest. Sometimes it is going to take longer for that to show positive slope if you're coming out of a sideways move. So sometimes if I like everything else I'm seeing about the stock or the ETF or whatever it is I'm trading, I may jump in already when the 20 and the 35 are already positive slope, with price above the 20 and 20 above the 35. And the other thing I like to see is the bottom bullet point here, all three moving averages having some sense of spread from each other, almost appearing parallel. And I'll show you what that looks like in a second. A downtrend would be the exact opposite. I need price underneath the 20-day or 20-week or 20-month, depending upon what time frame I'm looking, moving average. The 20 needs to be beneath the 35. The 35 needs to be beneath the 50. All three moving averages having negative slope, or again, the 20 and 35 at least having negative slope, and the 50 looking like it's getting there. And all three looking somewhat parallel to each other. So what this does is tell me when stocks or whatever it is I'm looking at, it's truly rallying and really worth buying. When markets are going nowhere and needlessly tying up your capital because you get in a position that is not going anywhere. So you're wasting your money in potentially finding something that can return you capital, make money, essentially. And when markets are truly declining, giving you full-scale signals that you don't want to be long and you essentially want to be short. If you play the short side of the market, there are some individual investors who simply just don't play the short side. So let's take a look at, here's Apple with TMAP on a weekly chart. And let's go to the lower left-hand corner. So the deep blue line is the 20, in this case, it's a weekly chart, so a 20-week moving average. The red is the 35, the green is the 50. Somewhere in late 2013, early 2014, you have the sense of what this signal is saying. Now, notice that price in, looks like February of 2014, gets underneath the blue, the 20-week moving average. So it's not a buy again until it breaks out above. And as long as you're seeing price generally leading all three moving averages as they're spread apart from each other and appearing somewhat parallel, they'll never be perfectly parallel, but you can see this sense of being spread apart, you have a real trend. So let's look at the first third of the chart on the left-hand side, pure bullish uptrend. We'll talk about what happens in the middle of 2015 in a second. From middle of 15 to middle of 16, you're in a downtrend. From middle of 16 all the way until the end of 2018, you're in an uptrend, and ever since, it's mishmash. And the moving averages are crossing over each other consistently, and that's why I also say it tells you there's no true trend when moving averages crisscross. So let's look at how do you get out of this? In this case, there's two things I look at to lighten up. One is if the lead moving average, the 20-week, goes flat, by necessity, it has to mean that that underlying security is not going anywhere. We all know what moving averages are. We all know how they're calculated. So if the lead moving average goes flat, then it means the underlying has stopped going up at a minimum. So when I see the moving average go flat, the 20, I often take off half. And I get out of the other half when it breaks underneath the 50-week, the green line. That's how I exit. Now, on this trade, you would have gotten half out in the middle of 15 and certainly half out on the first or second week that you closed under the green moving average. Still made very decent money. This now sets up over the next several months as a bearish trade. And you have price under the 20, 20 under the 35. Look at early 2016, late 2015. and the 35 under the 50. Right, so you can lean into the rally, you sell it, and it comes down again. You see in the middle of 2016, it flattens out. The blue line flattens out, means it's no longer doing what it had done. Take off half. Why? Just because the trend has potentially changed. You don't know for sure, but something different has occurred. If something different has occurred, that's enough for me to take half off. A week or two above the green gets me out of the short, and you can see by late 2016, early 2017, this goes back into an uptrend. And even in early 18, when we got beneath the 50 week, we didn't close beneath the 50 week. So might have been afraid, but if I simply use this, and notice I took every other model off, and I'm not suggesting you simply only use this. But what I've purposely done here is taken everything off the chart, every other indicator I use. You know that if you've heard me before, you know I use institutionally based models. That this is not typically what we would call an institutionally based model, stuff that's more sophisticated, that times the market in a different way. But what I want to show you is something that I realized about moving averages years ago. So let's take a look at, here's a more in-depth look at the Apple chart just more recently. And again, you can see towards the January of the latter part of 18, you lost positive slope. Either going flat or losing positive slope in the 20 indicates that there's a potential change of trend, just like it did in here. It told you the market was consolidating. Now, even if you sold out a half, it turned back into a bullish signal on this large bar higher. So you would have gone back into full long position. But you can see as of recent, it's much more choppy, even though there is a general uptrend here. Within the context of this large decline that we saw in late 2018, you're still in a choppy market. Here's WTI oil. One of the toughest markets to trade is the oil market, and yet this at least gave you two really solid trades, if not three. So if you go all the way to the far left, you actually were in bullish mode from the fall of 2018. It peaked out. You made a little money. Future traders always go short. These are people who go short. So you could have captured a decent amount of this decline, a large portion of the up move. And then here, since spring this year, kind of down move, and then you get chopped up and really nothing since. Look at gold. Now this is Dees gold. It didn't have a continuation chart, but you can still get the sense of the bullish move in the early part of 19, the bearish move, or at least choppiness, and then since June, middle of June, straight up move. Cotton, straight down move since May this year. Copper, choppiness in 2018, two moves this year to have captured some of. You're not going to get all in. Of course, with a moving average model, you're never going to get close to buying the low or selling the high. We all know they're lagging indicators. So this is different than a lot of other models I use, which actually play in the second and third standard deviation of price activity. This is much more geared for the first standard deviation to play the bulk of the move and leave the tails out of it. This is 3M. Since 2016, you caught a very good chunk of this. Towards the latter part of 2016, notice that you went completely flat. You would have taken half off. But by your early 2017, you're getting spread again. By March, price above all three. They're spread apart. They're all positively sloped. You get back in bullishly. And again, you would have gotten out of some price-wise on this bar down in here. And certainly within, let's say, 2 bars of getting under the 50, you would have been out. Spiders. Look at this on, now this is a monthly chart. You try this with the spiders on a daily and it gets chopped up. Look at the long-term trend of the market. So this said from 2009 to middle of 2011, late 2011, choppy, hard to really figure out. By early 2012, this is very clearly defined which way to play. And you'd be in it ever since. Now, one of the last charts I'm going to show you is, I call this Does It Matter? And the reason it doesn't matter was, and this is a slide I used 15 to 20 years ago, and I still have it, because it doesn't matter that this happens to be an old slide. The point is, if I had software, and I don't think I could do this on StockCharts.com, which is why I didn't put it up in here, and look for something more current. If you saw this chart, would you know how to play those 4 moves without even knowing what that was, what the underlying security was? You wouldn't need to know. This could be anything, and you'd be able to figure out how to play it. Now, what was it? By chance, it happened to have been a CRB back then. And you could have either played CRB futures or the major components of CRB. But this was the CRB index from the late 90s to about 2003. So what I'm showing you here is if you could see trends like this, so clearly defined, then this model shows the robustness of what it does, because you could essentially trade anything. You don't even have to know what it is. You just have to need to understand this simple model. So that's what I wanted to show you about using 3 moving averages. The most important things, again, price above for a bullish signal, price above the 20 above the 35, the 35 above the 50. All 3 positively sloped and somewhat spread apart from each other. That's a bullish signal. Bear signal, exact opposite. Price underneath the downward sloping 20. The 20 is underneath the downward sloping 35. The 35 is beneath the downward sloping 50. And somewhat spread apart from each other, somewhat looking parallel. We've got a pure bear market. So,
Excellent.
In our institutional newsletter, over the last year to date through August 2nd, I'm now up actually about 73% this year. But officially, until I do the month-end results, 69% this year. Last year, we made 24%. In 2017, 75%. The profit factor is something you should know about when you're comparing whether it's newsletters or hedge funds you might invest in. This is dollars made. It's a ratio of dollars made to dollars lost. So this year, you would have made $9.20 for every $1 you lost on my recommendations. Last year, $1.74 for every dollar lost. And that's just fair. But we still made 24% in the year that the S&P was down. And then in 2017, $6.67 for every dollar made. So I'm sorry, for every dollar lost. So anything 2 or better is considered quite good in the industry. So this is what we've done. Erin, I will turn it back to you if there are any questions.
Yes, there are some questions. I use the 20, 50, and 200-day EMAs for decision point analysis. That's how we get our market timing signals. What do you think about EMAs versus simple moving averages?
I typically use simple because they're the simplest thing often to find on a charting system. They've always worked for me. And the EMA is going to obviously put more weight on the most recent information, and therefore you could get flattening moving averages kicking you out of trades too soon. Mm-hmm. So that's why I'm content with just a simple moving average.
Right. And I know everybody sort of has their preferences. Do you base your analysis on always on those weekly charts?
Nope. I look at daily, weekly, and monthly. And ideally, it's great when you have all 3 say the same thing. Doesn't happen that often. I mean, in a rip-roaring stock like an Amazon's been up until maybe a year ago, you can often find all 3 giving you the same signal. But I like to look at all 3. But for medium-term investing, I'll generally look at a weekly chart.
Okay. Excellent. That pretty much covers the questions. They all sort of centered around the application of an EMA versus a simple moving average. And I found it interesting. Somebody was asking about specifically the 20, 50, and 200 days. If you've thought about applying those. Like, no, it doesn't. He doesn't need to do that. I do that.
Now, people often ask me why 20, 35, and 50 are these magical back-tested numbers? And the answer is no. It's they're just I like that they're uniformly spread from each other in the sense that there's 15 time periods in between the 20 to 35, and the same thing to the 35 to 50. I've looked at other ones, including some people like to use Fibonacci moving averages, so you might want to use 21, 34, and 55. You certainly could use anything you want. Those obviously are not equally spread out the way 20, 35, and 50 are. If you have a really solid trend, almost any combination without going out to 100 or 200, something really far away from the shorter ones, will work. If you tried to do 50, 100, 200, you'd have a heck of a hard time coming up with frequency of all of them being in the right place at the right time with the right slope and the right spread. That's why I tend to stay 50 or less in these numbers. And it's just stuff that's worked for me. So I don't go less than 14. I don't go more than generally 20 for the first one. And then it's just a matter of, finding a spread in between them that I feel comfortable. But when I first came up with TMAP, I used 20, 35, and 50. I liked the idea that it was just a really simple model to use. Any technical analysis software could put up, moving averages easily. And I tried to keep it really simple. So, you can play with this. You can try to back test. The thing about back testing is you're going to find it'll work perfect on one. And you might find a stock that has a particular rhythm, and you can fine tune these moving averages to try to get a little better feel for any particular security. But you'll find that it's not going to work uniformly. I like this because generally it works across anything I look at. And important to realize too is you may get a very ugly looking picture on a daily chart using 20, 35, and 50. And if you do, instantly move out to a weekly time frame. Anytime something's too choppy to get signals that are working, go out a time frame. If the weekly is all choppy, go to the monthly to get a sense of where's the long-term trend. So this is not going to be a 3-week trade. This is something, if you're looking at a monthly chart with 20, 35, and 50 month moving averages, this is more of a long-term investment type idea. But try to find a time frame that aptly suits this model. And that's the time frame you should use it for. So if it's too choppy in a daily chart, look at a weekly. Even if the weekly is sloppy, look at a monthly.
Hey, Rick.
Yeah, Tom.
Got a question here for you. You talked about the CRB earlier, and you've talked about individual stocks. What markets do you trade? I mean, is it just here in the U.S.? Do you look outside the U.S.?
Could I answer that question with the word yes? Everything.
Anything. Okay.
Yep. Anything.
So if you want to try to minimize risk, let's say, you got signals, you're bullish, you may be a little cautious. Would you ever consider maybe doing ETFs instead of individual stocks?
Oh, sure. In the No Trader, each week I put out in the No Trader on Wednesday nights, it's only ETF recommendations. I don't recommend individual stocks to individual investors. I think ETFs are the way to go, especially with the liquidity they provide, the intraday pricing, and the fact that you can really diffuse single stock risk by being in any ETF. But you could do this on individual stocks, certainly. Those were examples I gave you, but the concept works for anything.
Okay. One final question. We have about 30 seconds. I saw the XLF financials broke out above the May high back in July, and then since have kind of fallen back. Now, that was an absolute price breakout, but on a relative basis, financials have been struggling. So if you see an absolute breakout, do you also look at relative strength, or do you just simply base it on the price action?
Well, generally, I like to buy stuff in sectors that are outperforming in the first place. So I'm going to be more apt to buy into sectors I like, and less apt to buy into energy and some of the other healthcare ones that are you're fighting trend just in relative terms. You might make money in absolute terms, but you probably could have found something better if you were just in a different sector. So generally, I would say to listeners, You want to buy outperforming sectors and stay away from underperforming ones, just as a general rule.
All right, one final. I'm gonna slip one more in because there was a last second question just came in. If you were looking to add to the S&P 500 right now, to the SPDR, what would you be looking for to make that decision to add?
If I were going to buy SPDRs at this point, I'd be looking for not stuff from this model. I'd be using a Tomoric propulsion buy signal. I would be using a Tomoric setup 9 count on the downside, or a propulsion exhaustion signal on the downside. I'll either buy strength, where the signal will show up to do it, or by weakness when and if time appropriate.
Okay. And if somebody wants to follow you and follow your newsletter, should they go to inthenowtrader.com?
That's the place to go. Lots of videos up there, as well as information on how to subscribe. Awesome. And this year, honestly, this year's been terrific. Our growth has been magnificent. We have 4 times the amount of subscribers this year than we had last year. So it's really grown dramatically. And it's because really I present and help teach institutional models that individual investors don't have access to. And that's how we put on our trades. The whole purpose of In the Know Trader is to align yourselves with what institutions are doing, not what other individual investors are doing.
Okay, awesome. That's In the Know Trader. That's KNOW. inthenowtrader.com. If you want to follow Rick, we would certainly encourage you to check out his website. Rick, always a pleasure to have you here on Market Watchers Live. We look forward to getting you back soon.
Tom and Aaron, thanks so much. I appreciate it, and enjoy the very little bit left of summer.
Indeed. You as well.
Thank you.
Bye-bye.
All right, Aaron. I don't know, are you doing an RRG?
I do have one. We haven't looked at one in a while, so I figure we'll put one up here. I did move it to a daily setting. Like I said, one of our viewers pretty much said, hey, if you're looking at these 10 and 10 symbols in a short-term look, you probably should do that on a shorter-term RRG. So thought there was some interesting developments in the fact that we did even out here on technology and discretionary. And there are a few interesting stocks out there that we'll look at. Awesome.
All right. Well, we'll go ahead and we'll start with INFY.
Indeed.
All right. That is Infosys Technologies, our first stock today. I actually like the stock, but I'd like to see a breakout here. When I was picking my portfolios over at Earnings Beats, this was actually one that kind of got to the end, and I ended up not going with it, mostly because of the industry group relative to the S&P 500. You can see was down near about a 7-month low, but this stock has been really strong. I like the volume coming in here on these moves to the upside. We got a big spike to break out here back with earnings in July. So I think this one looks pretty good, but right now I'd say it's in a trading range, 1070 to 1160. Let's see which way it breaks. I'm suspecting we'll get a breakout above 1160.
All right. We had, let's see, 3 most popular in the chat room that I pulled down. So our first one is Aerojet Rocketdyne, AJRD.
All right, AJRD. Yeah, this is a really good one in the defense area. I like this stock a lot. We did get the breakout with its earnings report. It pulled back. I think that's kind of an area of support I'd watch really closely. That's where the buyers came in. So you've got price support 46. You've also got your 50-day moving average there. Good volume trends. I suspect we'll see this one go higher. I like it.
All right. Let's see. The next one up, also very popular, was XAR, the Aerospace and Defense ETF. So sort of staying in the same area.
Yeah, I'm more of a fan of the defense than I am the aerospace. But yeah, I think overall this chart looks pretty good. I'm actually just going to go to a regular. Don't need all the relative charts on this. I think what we have right now is an ascending triangle. So off of an uptrend, that's the first thing you have to notice with a pattern is you've got an uptrend in place. Because when you get a continuation pattern, you really want to make sure that you have something to continue. You need to have an uptrend or a downtrend already in place. So here you can see the equal highs coming across. Right here, you can see we've got the rising lows. So you got an uptrend, ascending triangle, a breakout above 107, in my opinion, would measure up probably to about the 114, 115 area.
All right, let's see. And the next one up is going to be JD.com. JD.
All right. JD. Well, we had some really nice volume here. We didn't get the breakout. And this is one of the things from a trading perspective I think is really important when you're trading a stock and you get up to that prior high. I know the emotional side says, man, I'm going to break out. We're going to just fly. But the practical side says that's where the sellers came in last time. And it's probably wouldn't be a bad idea to at least take partial profits when you hit a key resistance level. We're pulling back. I would be watching two levels here with big volume. This support zone down here, 28.20 to about 28.60 is going to be really important. But if we can put a tail below these moving averages and hold it, I think we could actually bounce from these moving averages. So if I was getting in, I would look at this level and then maybe save some powder in case we go back down here. Close below 28, 28.10, something like that would have me out of the stock.
All righty. Next one up is a semiconductor, Cirrus Logic, CRUS.
Yeah, the semiconductors, you got some hot ones and some not so hot ones. This is a hot one. I like Cirrus Logic. I love the fact that we came around here in this little cup. Didn't really have much of a handle, but a huge breakout on heavy volume. That was earnings related. And so I think the bottom of that candle right there, you can see after the gap up, a lot of times market makers are on the other side of the trade. So you'll see stock go back down because they're shorting at the open. When you get a gap up like this and it's the low of the day, that tends to show you there's a tremendous amount of demand in the stock. This is the trading range that I would use for now. Anything down close to that 20-day moving average to me would be a great reward to risk entry.
All right, excellent. Next one up is going to be EverQuote, internet stock.
Yeah, I really love this stock. I know it's having a down day today, but it's a volatile stock. It's been a great performer in the internet space. And so anytime you get a move like this, you're going to have some down days. I think it's an opportunity. It could go down all the way to the 20-day moving average. I'd be surprised if it gets down there, but great volume trends and really love the relative move that it's made versus its internet peers. So that right here, it was already uptrending, but then we just took it to a new level here with the earnings report, all the volume coming in. If it continues to pull back and you're looking for entry, I would say that 20-day moving average is exactly where I would be looking. In fact, maybe even building a position down to that 20-day would make sense. But it is an aggressive stock, so you want to make sure you're willing to take on the risks associated with those types of stocks.
All right. Next up is an industrial business support services, Booz Allen, BAH. I don't know, bah humbug here?
No, I really like this one. Another one that in the business support services, it's been a really good group. And I always talk about, having a group that's doing well versus the S&P, a stock versus the S&P rising, a stock versus its peers rising, its peers on an absolute basis, and then you can see, obviously, Booz Allen rising. Great volume trends. I don't know. I think, you always want to try to get a little bit better entry. Recent low in the 20-day, I'm going to say around 71, 72 would be a pretty nice entry here.
All right. Let's see. Next one is Lamb Weston, consumer staple, of course, LW.
All right. Lamb Weston. Got a little bit of a breakout here, but look at the relative strength. I mean, the group food products relative to the S&P topped all the way back in November, trying to get back through these recent highs. I mean, it's okay. I would probably look for something a little bit better. And this one was downtrending until recently. It is starting to show relative strength. So if I was going to trade something like this, knowing that it's in just kind of a meandering kind of a group, and it's just starting to show some relative strength, I would have to keep a fairly tight stop. So right there, you got a breakout. And then maybe the rising 20-day is definitely as far as I would go to the downside. So I think if you close below 67, I'd be out.
All right. Let's see. The next one is going to be a software company, EPAM, EPAM. I just got a PMO buy signal.
Yeah, I think this one had pretty good earnings from what I recall. Yeah, I like it. I think you got an uptrend. This is probably going to result in the cup. You got great relative strength. So there are a number of things that I really like about this stock, but I think you might run into a little resistance when you get back up just above that 200 level. That was the high in July. I'd want to see a big volume breakout on that move. Otherwise, I'd maybe look for a pullback to test that rising 20-day moving average, which is down around 190. But otherwise, I mean, I think you got a good looking stock. It's in a great area of the market. And when you're in one of the best areas of the market and you're breaking out relative to your peers, that's generally going to be a pretty good sign. So I would be fine with this one. It's just getting close to that resistance area. So maybe be a little careful there.
All righty. And the last one is going to be SOLY.
All right. I don't know this one.
Yeah, it's in the healthcare, I believe. Yeah, medical equipment. It's new.
Yeah, I love the group. Medical equipment, as you can see, relative to the S&P 500 has been, just awesome. So I think, being in this group is a good thing. I'm not sure that this is the stock that I would be looking at in medical equipment. Also, I think if you take a look at the relative weakness here over the last 2 or 3 months, it's starting to strengthen here the last couple of weeks, but we've been moving lower here with the group moving up. So overall, this stock's been moving down while the group's been moving up. I maybe would be looking for a price breakout. That would help. A move back up above 15. That would get us above both moving averages and also against that above that price resistance area, that reaction high that was established in July. So I got mixed signals here. I really like the group. I just think maybe there's some other stocks that, at least right now, look better to me.
All right. That's it. That is 10 stocks in 10 minutes. And there you go. Those are the ones that Tom covered. Really good job again. You've got this down.
Yeah. Well, I tell you what, having it at the 10 and 10 at the end of the show puts a little pressure on to get it done in 10 minutes.
Exactly. I noticed the same when you were gone.
Yeah. It doesn't really give me much choice. But that was fun. It was a good show. Enjoyed having Rick back. And, we got a poll up here. I know, Aaron, you've talked about recently the defensive groups have been leading, and that's got you a little concerned. Mm-hmm. If you look out in your crystal ball the next month, what do you think? Do you agree with those saying yes, that real estate and utilities are going to continue to lead? What do you think?
Well, I don't have a crystal ball. I wish I did. But, honestly, I think that it's going to be time. The only reason I'm getting a little bit more bullish right now is my intermediate term indicators are just starting to look a lot better. And if that's the case, then I would expect these industry groups, these sectors to start pulling back at this point and handing leadership over to those more aggressive sectors in the intermediate term. Through September, I think we could still see them leading, but I think we're getting ready to have a switch off here next month.
Yeah, I'm going to say no. I'm going to go with the minority here. I think the easy answer would be to say yes, because September historically is not a great month. And if you look at the relative performance, usually real estate and utilities do well in the month of September on a relative basis to the S&P 500. So that would be with all the uncertainty, I can understand it, but I'm going to say no. I think that the market is in much better shape than most people believe. And I think that we're going to see a return to some of the aggressive groups. So we'll see.
So I think we sort of agree.
Yeah, we do kind of agree in a weird sort of way, right? Here is your final market update. As you can see, you got the NASDAQ down 35. So we got a little, that's lagging, the Dow leading up 0.2% today. All right, I want to thank all of you for being with us. A special shout out to Rick Bensignor for joining us as well. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here tomorrow. Happy trading.